So we did chapter 6 already. So let's close that. We like to do chapter 7, which is about variable costing, segment reporting, and we like to go all the way down to look at variable costing, absorption costing. Absorption costing is the regular type of calculation of cost that you learn in financial accounting. But variable costing, it's more like managerial type of costing, which managers, they really like to do variable costing so they can see the variable expenses in a business, fixed expenses in a business, and then using those variables and fixed expenses, they can do cost volume profit analysis. Because when you know how much fixed expenses you have, you can easily calculate break-even point, target profiting. And so variable costing is more like a management type of thing. But you need to see the difference of variable costing and absorption costing. Any business has an operating expense. Operating expense has two parts: selling and administrative expense. Selling and administrative expenses, they have also variables and fixed expenses. So when we are talking about variable expenses, we are also referring to selling variable expenses or general administrative variable expenses. When we refer to fixed expenses, we also refer that fixed expense includes to anything that it's in selling expense and general administrative expense. Okay, so here you see that it shows variable costing format income statement that provides you contribution margin information. But we have absorption costing income statement, which you learn that type of income statement in financial accounting. So it's the same thing, but you need to know the difference in regards to variable costing income statement and absorption costing. In absorption costing, you have cost of goods sold. So sales minus cost of goods sold gives you gross profit. But in the variable costing, you have sales minus variable expenses gives you contribution margin. Contribution margin is a dollar amount that you can use it to pay for fixed expenses in the business. So those are two different type of income statement, even though in some cases the net income would be exactly the same, but the amount of information that you get from it, it will be totally different. Okay, and here is talking about cost volume profit analysis. And in order to do cost volume profit analysis, obviously you need to know variable expenses, all variable expenses, and all fixed expenses in your business, okay? Okay, so let's go to exercise. Yeah, exercise 7-1. It says, Ida produces a handcrafted musical instrument called a gamelan that is similar to xylophone or something like that. The gamelans are sold for $850. Selected data for the company's operations last year follows. So they are selling $850, okay? So we have some data: beginning inventory, unit produced, unit sold, units in ending inventory. So just here, be careful what you are looking at. You have unit production of 250, but you sold less, okay? Unit produced 250, but you sold less. Remember that. It might be handy later on. Units in ending inventory is 25, obviously, because you sold less. Variable cost per unit, direct material is variable. Yes. Direct labor is always variable. Yes, because if you don't produce anything, it will be no cost. Manufacturing overhead has two types of things, either variable or fixed. So here, variable manufacturing overhead is 40. And also remember I said variable and administrative expenses might be fixed and variable. So here is the variable cost for selling and administrative. However, we need to also know exactly what the fixed cost we have. The fixed cost we have is $60,000 for the manufacturing overhead and $20,000 for selling and administrative. So it's an awesome problem, looks like. Assume that the company use absorption costing. Compute the unit product cost for 1 gamma. Assume that the company is using variable costing. Compute the unit product cost for 1 gamma. Okay, so I have here, right there. So number one, under absorption costing, all manufacturing costs, including variables and fixed, are included in the product cost, just like regular income statement that you learned already. So it will be direct material, direct labor, variable manufacturing overhead, fixed manufacturing overhead, add them up, that will be the total cost. 3 things you need to make something, material, labor, and overhead. So here we go. Material is $100, direct labor is $320. Overhead is 40 for variable, but fixed we don't know, you have to calculate. So $60,000 divided by 250 units of production, that gives us 240 at this moment, okay? If you produce more or less, the 240 will change, okay? But for now, based on 250 units of production, that's $240 for fixed manufacturing overhead per unit. Add them up, your absorption costing unit product cost ends up to be $700. How about variable costing manufacturing? Include this: material, variable, yes. Labor is variable. Variable manufacturing overhead, which is $40, we have it already. And that gives us variable costing unit product cost of only $460. So as you see under variable costing, we just add up the variable cost because fixed cost is gonna happen no matter what. So we just wanna know how much really variable we have if we start producing anything. If we don't produce anything, the fixed expenses, no matter what, either you like it or not, is gonna happen. Make sense? That's why it's important also to understand what is the variable cost. Note that selling administrative expenses are not treated as product cost under either absorption or variable costing. These expenses are always treated as period cost and are charged against the current period's revenue. So under variable costing, your fixed expenses will be below contribution margin. And below contribution margin means period cost, right? Those gonna happen no matter what. Okay, so let's go to exercise 7.2. Here is 7.2. It says, refer to data in exercise 7.1 for IDA. The absorption costing income statement prepared by the company's accountant for the last year appears below. Sales minus cost of goods sold gives you gross profit. Gross profit minus operating expenses gives you net operating income. Under the absorption costing, how much fixed manufacturing overhead cost is included in the company's inventory at the end of the last year? Prepare an income statement for last year using variable costing. Explain the difference in net operating income between the two costing methods. I'm going to explain this and listen carefully because it is literally also a CPA exam type of question. not only in my class, but also a CPA exam question. So let's look at the solution for now. So fixed manufacturing overhead costs deferred in inventory by 25 units. Remember, we produced 250 and sold 225. So we produced more and we sold less, right? We produced more and we sold less. Therefore, 25 units is in the ending inventory. The 5 units includes $240 per unit of fixed expenses. Remember, fixed expenses was $60,000 divided by 250 units of production gives us fixed expense of $240 dollars per unit. So fixed manufacturing overhead of 240 times 25, which is $6,000 under absorption costing will be absorbed and saved by ending inventory at this moment in the inventory T account. So $6,000 more compared to variable cost. The variable costing income statement appears below. Sales was same thing, 191 to 50, no difference. Variable expense was 225 units sold times 460 variable per unit, which we calculated already from here, right there. Remember? Okay, so 460, that gives us $103,500. Variable selling and administrative is $225 per unit, which is $20 per unit, right? I think that was here, right there. Where is it? Variable selling administrative expense, $20 per unit is somewhere here. Here. You see that? Right there. Okay, so that gives us the two variables that we need to calculate: variable cost of goods sold and variable selling administrative. So all variables will be added to become 108,000 minus sales gives us gross, contribution margin, contribution margin under variable costing, contribution margin of 83,250. So what is contribution margin? Contribution margin is sales minus all variable expenses. Gives us a dollar amount that with that dollar amount, we can pay all fixed expenses in the business. All fixed expenses in the business. So what fixed expenses we have? We have in the factory, we have manufacturing overhead fixed expenses, and also we have fixed selling and administrative expenses in our other side of the business. So here we go, 60,000 for manufacturing overhead fixed and 20 for selling administrative fixed. And that comes from here, right there, see? Problem 7.1, got it? Okay, so 60 plus 20 is 80. So contribution margin, it's a dollar amount that will help us to pay all fixed expenses, and that's $80,000. So that gives us a net operating income of $3,250. And as you see, compared to absorption costing, the net operating income will be much less, okay? Much less, because under absorption costing, we have higher, and under variable costing, the net income will be less. So let me now repeat whatever I just said. Listen carefully, this is a CPA exam also. Under variable costing, If you produce more, sell less, your net income is less. One more time. Under variable costing income statement. If you produce more, 250 units, and you sell less, 225 units, then your net income is less. One more time. Under variable costing, you produce more, you sell less, net income is less. One more time. Under variable costing, you produce more, you sell less, your net income is less. Good. And not only your net income is less under variable costing, your ending inventory is also less. Your ending inventory is also less. Why? Because under variable costing, all fixed manufacturing overhead will be spent immediately. That means your ending inventory under variable costing only includes the variable expenses, because all the fixed expenses are already expensed here. So it's not absorbed by ending inventory. Got it? So let's put it together one more time. Write it down if you like. Under variable costing income statement, if you produce more, you sell less, your net income is less, your ending inventory is less. Got it? And that's something that you need to remember. And the opposite of whatever I just said is also true. But you don't need to memorize both sides. Just memorize whatever I just said, and the opposite is true. So one more time, under variable costing, if you produce more, you sell less, your net income is less, your ending inventory is less. Got it? Hopefully. Okay. So under variable costing, as you see, the variable costing, your ending inventory will be much less because you have only variable expenses per unit in the inventory. All the fixed expenses here are already absorbed and expensed in the income statement. Okay, so here is whatever I was trying to explain. So you can read it again if you like. And that's what it is. Okay, let's do 7.3. So here is a reconciliation of absorption and variable costing net operating income. So the company manufactures heavy-duty street lighting. The company uses variable costing for internal management. Remember, I said variable costing is for internal management only. And absorption costing for, obviously, external reporting, right? The company has provided the following data. In year one, beginning inventory was 200, ending inventory was 170. So just look at here. The beginning was 200 and ending was 170. That means they produced less and they sold more. They produced less, they sold more. Why they sold more? Because the ending inventory went down. So remember I said under variable costing, if you produce more, you sell less, net income is less. So the opposite is true. Under variable costing, if you produce less and you sell more, then your net income will be more. Okay. So let's see, those are the data we have. The company's fixed manufacturing overhead per unit was constant at 560 for all 3 years. Okay. Calculate each year's absorption costing net operating income. Present your answers in the form of reconciliation report. Okay, let's do that number one first. So in year one, the beginning inventory was 200. We sold we end up by having just 170. That means we produced less and sold more. So change inventory is minus 30, right? Because we produced less, sold more. That's why we are in negative inventory by 30 units. Fixed manufacturing overhead in ending inventory are 560 per unit. So 560 per unit, that is let me see. $560, we have 170 units left, right? So let me calculate that for a second, just to make sure, tell you the right thing. So 560 times 170, it is 95,200. So how do you know this is fixed manufacturing overhead in ending inventories should be how much? If we do absorption costing, it should be in the absorbed by the ending inventory, right? How much should be absorbed? 560 per unit, and we have 170. So ending inventory should be 95,200 just because of that fixed expenses, more value. Fixed manufacturing overhead in beginning inventories was 560 times 200. Let me calculate. 560 times 200. That's $112,000, right? So 95 minus 112, that means fixed manufacturing overhead deferred in the released from inventories is 16,800. That means the ending inventory under variable costing only includes variables, right? Right, only include variables. So 116,800 has been expensed under variable costing, because under variable costing, all fixed expenses will be expensed immediately. Nothing will be absorbed by absorption costing. So variable costing net income operating is 1,180,000. Here, 1,080,000, right? And 1,080,000, that's a variable costing. So variable costing operating income. Add fixed manufacturing overhead cost deferred in release from inventory under absorption costing. Then absorption costing net income will be $1,063,600. So look at these two numbers, that number and that number. Now let me repeat whatever I said. Under variable costing, if you produce less and sell more, then your ending net income will be more. Whatever I said like 10 minutes ago, remember I said under variable costing, if you produce more, sell less, net income is less. Now I'm doing the opposite of it. Under variable costing, if you produce less, sell more, net income is more. One more time, under variable costing, if you produce less and you sell more, 30 units more, then your net income is more. How much more? Here, $16,800 more. $16,800 more. Got it? So that's why under variable costing, in year one, your net income is more than absorption costing. Make sense? Your variable costing will be more than absorption costing. And the reason is under variable costing, the 560 units per unit is expensed in the variable costing. But this year, you produced less, you sold more. If you produced less and you sold more, then your variable costing will have more net income. And the reason your variable costing will have more net income, because the items that you sold under variable costing, the fixed expense has been already expensed the year before, and variable costing per unit is much less, and you sold it for a certain dollar amount, you make more money, you make more net income. But under absorption costing, because you absorbed already the fixed expense from the previous period in the inventory, so your inventory total cost per unit is high. All of a sudden you are selling those, then you are spending all those fixed expenses, therefore your net income will be lower. Let's go to year two. In year two, you had 170, but you end up with 180. That means you produced less, produced more, and sold less. You produced more and sold less. That's why you have 10 extra units left. Make sense? You produced more, sold less. That's why ending unit is 10, has 10 extra units left. So remember I said under variable costing, if you produce more, you sell less, your net income is less compared to absorption costing. So here is the fixed manufacturing overhead in ending inventory is 180 times 100. Ending inventory is 180. Yes, 180 times 560. Let me calculate that. 180 times 560, and that's 100,800 bucks. Correct. Yes, right there. Right. Now, fixed manufacturing overhead in the beginning was 170 times 560. 170 times $560 per unit. That's $95,200 right there. So the difference is $5,600 fixed manufacturing overhead deferred in inventories, right? $5,600 fixed manufacturing deferred in inventories under absorption costing. But under variable costing, it is expensed already. So remember I said under variable costing, if you produce more, you sell less, your net income will be less. Remember that word? Okay, here we go. So variable costing, we have under absorption costing, under variable costing, we have $1,032,400, which is coming from here, right there. And we have $5,600 absorbed in the under absorption costing in the ending inventory. That means our operating income will be higher because the cost is lower. The cost of inventory is absorbed in the ending inventory by 10 units that we have left in the inventory higher than beginning, right? So that 10 units includes under absorption costing includes the fixed expenses by 10 units. 560 times 10 is 5,600. So $5,600 is in the ending inventory under absorption costing, like regular net income, regular income statement. So as you see, as I said before, under variable costing, if you produce more, you sell less, your net income is less. Net income is less compared to absorption costing. So under absorption costing, net income, as you see here, is higher than that. So one more time, under variable costing, if you produce more, you sell less, your net income is less compared to absorption costing. Same thing true on year 3. Year 3, we have 180 units. We end up by having 220. So again, looks like in year 3, we produce less. No, actually, we produced more, sold less. That's why we have more ending inventory. So we produced more, sold less. That's why we have more ending inventory by 40 units. Fixed manufacturing overhead is 180. Fixed manufacturing overhead in ending, 220 times 560, that's 123,200. But fixed manufacturing overhead in the beginning was 180 times 560, that's $100,800. The difference is 22,400. The under variable costing, remember if I said if you produce more and you sell less, your net income is less. So the net income is less than, here we go, less than absorption costing right there. By how much? By 22,400. That's the fixed expenses that has been absorbed under absorption costing in the ending inventory and never expensed. Therefore, the net income will be higher because the fixed expense is not expensed yet in the income statement. And here is the description. Okay. I wanna go to problem 7-5. Okay, how to calculate this? I want to show you a paper that I created just so you can learn from this. Take a note. It is very comprehensive formula. So I'm gonna change this to my desktop camera. And here we go. This is a comprehensive formula to solve for 2 different things: break-even point calculation and target profit calculation. Okay, break-even point calculation and target profit calculation. So how do you do that? Right, break-even point in units. Break-even point in units equals to. Now remember this: every business, every night, the manager is thinking about one thing and one thing only. How do I pay for all these fixed expenses every single period, every single year? How do I pay for all fixed expenses every single year? That's the main concern. That's why it's at the top of the equation right there, right? But because we are calculating break-even point, then our target profit will be 0. So for break-even point means Manager is thinking how to pay for all fixed expenses and having a zero target profit just to survive, just to break even, divided by contribution margin per unit. Contribution margin per unit. Let's say you are selling it for $10. Variable expenses are, let's say, $4. So 10 minus 4, it gives you contribution margin per unit of $6, right? All variable expenses. Okay, so fixed expenses plus target profit divided by contribution margin per unit. That gives you sales for break-even point in units. But you might say, how about if I want to calculate break-even point in sales dollar? If you are talking about dollar, the top is the same thing, but the denominator is contribution margin ratio. Dollar ratio. Dollar ratio. If you like to calculate target profit, a specific target profit, then all you need to do, instead of zero target profit, change it to whatever target profit you are looking for. And that gives you contribution sales in units to get to the target profit, and sales in dollars to get to the target profit. So as you see, this formula that I'm giving you, it's a comprehensive formula. All you need to do is just apply this to all your cost volume profit analysis calculation. You might say, okay, what is the margin of safety? Margin of safety is any dollar amount or any units above the break-even point. That's your margin of safety. Margin of safety in units or margin of safety in dollar. So if you are normally selling, let's say 100 units and you break even, 100 units, you break even. Now, if you sell, let's say 140 units, then your margin of safety is 100 minus 140. That gives you 40 units of sales for margin of safety. Same thing in the dollar amount. So whatever dollar amount you are selling above the break-even point in dollars, that's your margin of safety. And if you want to calculate the margin of safety in ratio, just divide your margin of safety dollar amount divided by total sales. And that gives you margin of safety ratio. That means how much of your sales you can lose and still stay safe. Margin of safety. Okay, so let's stop this. So here is the example. The company, problem number 7. The company produces and sells 2 packaged products, wheat band, no, 7, sorry. That one. Sorry, exercise 5. 7-5. Okay. The company segment is its business into 2 regions. So they have 2 regions in the business, North and South. The company prepared the contribution format segmented income statement as follow. Here is the company's total cost. Here is the North related information. Here is the South related information. Here is the sales variable expenses, gives you contribution margin. Using contribution margin, you can pay all fixed expenses and have a segment margin. Let's say in this scenario for North, segment margin is 60,000. For South, segment margin is also 60,000. But we have common fixed expenses of 50. Therefore, net operating income ends up to be only $70,000. We have a common fixed expense that has nothing to do specifically with North or South. Compute the company's wide break-even point in dollars, break-even point in dollar sales for North, and compute break-even point in dollar sales for South. So this is a very nice problem, and I like to solve this for you. And that is also part of your homework anyway. So here we go. Company-wide break-even point is computed as follows. Traceable fixed expenses, right, whatever it is, plus common fixed expenses, which is combined total fixed expenses, right, plus zero target profit here, plus zero target profit, which is not in here because the way I show you, it's a comprehensive formula. Don't tell anyone here. It's just my way of showing you a formula that you can apply to anything. But just imagine here is a plus zero target profit divided by contribution margin ratio, overall contribution margin ratio. So this is company-wide, okay? Okay, so total fixed expenses are 120, which is here. 60 plus 60, right? 60 plus 60 is 120. And sorry, here, 60 plus 60 is 120, right there. Traceable fixed expense. Plus 50,000 common fixed expense. That gives us total fixed expense of 170. Contribution margin ratio is overall contribution margin ratio. Let me show you what it is. Overall contribution margin ratio is that one, 240, divided by sales. 240 divided by sales gives you overall company-wide contribution margin, right? 240 by 600. So that's 240 divided by 600. That gives you 40% overall contribution margin. So 170 divided by 40% contribution margin gives us $425,000 of sales that we need to sell every year just to break even company-wide. Now let's look at the North region of same thing. North region, we have segmented fixed expense of 60,000, right? Right there. Divided by contribution margin for the segment. Contribution margin for the segment is 120 divided by 400. 120 divided by 400. So here we go. 120 divided by 400. That gives you 30% contribution margin for the segment. Okay, so fixed expenses plus zero target profit divided by 30% contribution margin per segment, North segment, gives you $200,000 of sales. How about, I just add a little bit. How about if I ask you, how about North section wants to make $50,000 of target profit. How much they have to sell? So you will say 60 plus 50,000 target profit divided by contribution margin ratio gives you the dollar amount of sales that North needs to sell to satisfy the target profit. Make sense? So my formula, it will provide you a very comprehensive tool so you can apply to every single calculation here, right? Now let's do the same thing for South. South has fixed expenses of $60,000. Here, $60,000. And the contribution margin ratio is 120 out of 200. 120 out of 200. Okay, so 60 divided by 120 out of 200. That gives you 60% contribution margin. So 60 divided by plus zero target profit divided by 60% contribution margin. That gives you total sales of $100,000. Total sales of $100,000. And if, let's say in this example, I add how about South wants to make $25,000 target profit? Then how much they have to sell? You say 60 plus 25,000 target profit, my formula, remember, divide by contribution margin ratio gives you the dollar amount. If you want to calculate contribution margin per unit, then you put contribution margin per unit here, and then you get contribution margin per unit, break-even point per unit here. But if you use ratio, then you get the dollar. Cool? So if we have company-wide sales, because we have also fixed expense, common fixed expense, right? Company-wide sales, we have break-even point for North, we have break-even point for South. That's about it. So I did few problems. Hopefully you learn from it. You have some more problems yourself. For chapter 7, please refer to your book. Book is very comprehensive. And look at those examples so you can apply that knowledge to solve your rest of the problems. Okay. Have a good day. Bye-bye.